and as I mentioned, my name is Jamie.
This meeting is being recorded.
My name is Jamie Jackson. I'm with the Canada Revenue Agency. So as we talked earlier, folks can feel free to put their questions in the chat. And I think maybe for the sake of disruption or anything like that, if you want to post them in the chat, we can go through them from start to finish when we're finished with the presentation. If there's something that's really important to you, feel free to break in, but otherwise we'll continue on until the end. So let me begin with my presentation. So again, my name is Jamie Jackson. I'm with the Outreach Program with the Canada Revenue Agency. I'm really pleased to be here tonight to speak with you about the disability tax credit and other benefits and credits available to persons with disabilities. And I'm coming to you from Mi'kmaq, which is the traditional and unceded territory of the Mi'kmaq people. So this evening, we're going to cover a few topics. I'm going to start by giving you an overview of the disability tax credit. Next, I'll touch on the other benefits and credits available to persons with disabilities. These include the Child Disability Benefit, the Canada Caregiver Credit, and how to get help to complete your taxes. So we'll get started. So a big question is, what is the disability tax credit? The disability tax credit, commonly referred to as the DTC, the purpose of the disability tax credit is to provide some relief for the unavoidable additional expenses that result from living with a disability. It helps to offset costs other taxpayers don't have to face. It certainly doesn't offset all of the costs, but it is a help for persons with disabilities with some of those extra costs that they face. So the disability tax credit is a non-refundable tax credit that helps persons with disabilities or their supporting family members. Because it is non-refundable, it reduces the amount of income tax that they may have to pay. But if you are in the situation where you don't pay a lot of tax in during the year or you don't pay any tax in, the benefit of the disability tax credit is certainly less than someone who may be working and paying in a significant amount of tax. And I think it's important to be clear with that right from the beginning, as we do have, we encounter, every group that we meet with, you may find two individuals with the same disability who feel that the disability tax credit has a different impact on each of them. So, and that's due to the fact that it's a non-refundable tax credit. Now, a supporting family member can be a spouse or a common law partner, a parent or grandparent, child, grandchild, brother, sister, uncle, aunt, niece, or nephew of the person with the disability. And there's a supplement for persons under the age of 18 that is they're eligible for if they qualify for the disability tax credit. Being eligible for the disability tax credit can also open the door and act as a gatekeeper to other federal, provincial, and territorial programs, such as the one that Jen's going to talk about, the Registered Disability Savings Plan, the Canada Workers Benefit, and the Child Disability Benefit. This aspect of the disability tax credit is particularly important for those with low income. It's important that all eligible individuals apply for the disability tax credit, regardless of their taxable income, in order to ensure that they qualify for other disability-related programs, benefits, and plans. And the main thing is you can't access these critical programs without first qualifying for the disability tax credit. So if you're eligible for the disability tax credit, you can claim the disability amount of up to $8,662 on your tax return. For those under the age of 18, you can also claim a supplement of up to $5,053. All or part of the credit amount can also be transferred to a spouse or common law partner or another supporting family member, as I mentioned on the previous slide. So if the disability tax credit itself is not of use to the person themselves that has a disability, it can be of benefit to, like I said, the spouse, common law partner, children, aunts, uncles, whomever might be providing support to that individual. So we'll take a look now at the eligibility for the disability tax credit. So when we talk about eligibility, it's important to note that eligibility for the disability tax credit is based on the effects of the impairment and not on the medical condition. This is one of the main areas that we hear from individuals when they say that, well, I applied for the disability tax credit, I have a certain condition. Clearly by saying that I have that condition, I should qualify. But when they look at the eligibility, it's about the effects of the impairment on your day-to-day life. So for example, we'll say there are two people who have the same medical condition. They both have a walking impairment. Now, over the same distance, one can walk at a reasonable pace while the other needs a walker and must stop frequently to rest. Although these two people have the same medical condition, the effects are very different. So a medical practitioner has to certify that you have what we consider to be a severe and prolonged impairment and provide the effects of that impairment. So the physician or whoever's filling out the form needs to say how your condition is impacting on your day-to-day life. Eligibility for the disability tax credit is based on the information that the doctor or the nurse practitioner or so on, what they provide. And your medical practitioner is also asked to provide the year that your activities became markedly restricted. Please also note that you may not be eligible for the disability tax credit even if you receive the Canada Pension Plan or Quebec Pension Plan disability benefits, workers' compensation benefits, or other type of disability or insurance benefits. And that's because their criteria, although many of them are similar, they can have differences. And one being eligible for one doesn't necessarily make you eligible for all of them. So the only way to find out if you're eligible is to fill out and submit the form T2201 disability tax credit certificate with input from your medical practitioner. Eligibility for the disability tax credit falls under these categories. And there are a number of different ones, and I'll go through them. So vision, speaking, hearing, walking, eliminating, which is bowel and bladder functions, feeding, dressing, mental functions necessary for everyday life, the cumulative effects of significant limitations, and I'll talk about that in a moment, or life-sustaining therapy. So the following categories have their own unique criteria. So for vision, the criteria is based on a certain degree of, your field of vision has to be a certain number of degrees, and your vision has to be a certain number on the Snellen chart. So that is one that has a very fixed criteria. For cumulative effects of significant limitations, so when you can see here the eligibility criteria and they have speaking, hearing, walking, feeding, and so on. If one of those does not on its own have the effect of being present 90% of the time and lasting for a year or more, the combination of a couple, and I guess that's the simplest way to put it, is that the combination of a couple of your disabilities, whether it be dressing and walking, if you had trouble dressing and walking, then maybe it takes you 3-4 times longer to get out of the house to go to church or something like that. That's what we're looking for. It's generally 3 times longer than someone who doesn't have the disability. So when you look at these criteria, I think it opens up the eligibility to a lot more people when you consider that, you know, maybe the combination of a couple of things here is going to make you eligible for the credit. So one of the things I mentioned was markedly restricted. So an individual may be eligible if they have an impairment in mental or physical functions that is severe and prolonged, resulting in a marked restriction. So marked restriction means that even with appropriate therapy, devices, and medication, the individual is unable or takes an inordinate amount of time to perform activities or functions in one of the impairment categories. I'm just going to break that down a little bit. So when we say markedly restricted, it means that, you know, even if they had a cane to help them walking, if they had medicine to help them with some of their other conditions, that's still there and it's present, you know, 90% of the time. The other thing that we talk about is severe and prolonged. So when we say severe and prolonged, it has to have been in effect or is going to last for a period of at least a year. And many of our clients will go into their physician and ask them to fill out the form, and it'll have been something that's been ongoing for a number of years, and they thought that, well, you know, there's other people maybe that are worse off than me. We want you to go in and apply or have this form filled out by your doctor and apply. Everyone that's eligible should be receiving it, and that's one of the reasons why we're happy to do the outreach that we're doing tonight. We just want you to know that the Canada Revenue Agency does want you to receive this if you're eligible. So the medical practitioner, when they fill out your form, as I mentioned earlier, they're asked to provide the year that the eligibility criteria is met. That's not necessarily the date that the diagnosis was made but rather when you began to experience significant changes to your abilities. So you may have bounced around between a few physicians, or your doctor may have retired and you've had trouble finding a new one. If your condition's been ongoing for a period of time, that's what that physician or medical practitioner needs to know, is how long has this been restricting your abilities, and that needs to be indicated on that form. And when we talk about that, it's the ability to go back for a number of years to the period when the disability began, both in filing your taxes and reviewing for that credit. So it's important to indicate when that started. So as I mentioned earlier, there are the categories that have unique criteria. The first one is vision. So you are certainly eligible if you are blind, but a person is considered blind if, even with the use of corrective lenses or medication, both eyes meet at least one of the following criteria. So their visual acuity is 20/200 or 660 or less on the Snellen chart, or the greatest diameter of the field of vision is 20 degrees or less. So that's, as I said, it has some very unique and specific criteria. So that is it for vision. Again, the second category we talked about was the cumulative effect of significant limitations. And I realize those are a lot of big words. So limitations in two or more of the categories that we'd mentioned earlier, with the exception of life-sustaining therapy. These limitations must exist together all or substantially all the time, and have a combined impact that is equivalent to being unable or taking an inordinate amount of time in one category. It needs to be present all or substantially all of the time, which is generally considered to be 90% of the time or more. Again, even with appropriate therapy, devices, or medication. Yeah, and as just a note that when we say all or substantially all the time, the number is interpreted to be 90% of the time. So the final category with unique criteria is life-sustaining therapy. The criteria for life-sustaining therapy is met when therapy is needed to support a vital function at least 3 times per week for an average of at least 14 hours per week. This is true even if the therapy eases the symptoms. You must also have to dedicate time for the therapy. That is, you have to take time away from your normal everyday activities to receive it. This time includes the time you need to set up a portable device. So when we talk about life-sustaining therapy, it could be someone who is receiving treatment for dialysis, receiving dialysis treatment. It could be for someone who has uncontrolled diabetes and needs to be in the hospital, or is constantly checking their, waking up in the middle of the night to check their blood sugar. There are some activities though that do not count in the 14 hours a week. So that would be the time a portable or implanted device takes to deliver therapy. So if you were on an insulin pump, for instance, and it did its work throughout the night, you wouldn't count those hours as 14 hours. Someone who has breathing difficulty and has a CPAP machine, you wouldn't count the hours that the CPAP machine is running. But if having that disability with breathing made it, it was there 90% of the time and it made it harder for you to walk down the street, you still should be applying. Activities related to dietary restrictions or regimes, even when these activities are a factor in determining the daily dosage of medication. So someone who's on a carbohydrate calculation, that wouldn't be included. That time to dose wouldn't be included. As well as activities related to exercising, even when these activities are a factor in determining the daily dosage of medication. Also not included would be travel time to receive therapy, going to medical appointments, buying medication, or recuperating. So we're just going to talk a little bit about how to apply. Now, many of you in the group may have applied and some haven't. So we're kind of covering this information, not just for you, but maybe even for friends or family or people that you know. So to apply for the disability tax credit, you must complete Form T2201, called the Disability Tax Credit Certificate. You can find this on the CRA website by looking up Form T2201. And you can either fill a fillable PDF or you can print a copy to fill out manually. The form, though, has 2 parts, Part A and Part B. So Part A has to be filled out and signed by the person with the disability or a legal representative. Part B has to be filled out and signed by a medical practitioner manually or on paper or by using, there's a new digital application, and doctors are able to now fill it out digitally, print a copy, and provide it to the patient. And when completing that digital copy, and I'm not sure if it's covered in the back part of this presentation or not, but they're able to select very specifically based on your disability, and they don't have to go through all of the pages that are not necessary. So it's good, it's time saving for the physicians, which I think is one of the reasons why sometimes it's difficult to get them to complete it. So the new online form has been out for a little less than a year, I guess, and it's been beneficial. So Part A, again, has to be filled out by the person with the disability, or it could be a parent or a legal representative. Part B is filled out by the medical practitioner and signed. And that medical practitioner could be a doctor or nurse practitioner. It could be, depending on the impairment, it could be one of the other medical practitioners that is assisting you, such as a specialist. So when you send the form to the CRA, after it's completed, it's important to make a copy so that if if they're looking for any more information, or if you want to go back to it to reapply, that you have a copy of that form. You can mail the completed form to the CRA through the regular mail, or if you're registered for My Account to represent a client, you can use those services to submit the form online using the secure online tool called Submit Documents. So in the previous slide, I mentioned medical doctors and nurse practitioners. They can certify all sections of the form T2201. Other medical practitioners can also fill out the Part B of your form, but they can only certify the following. So an optometrist obviously is going to be able to fill out for vision, an audiologist for hearing, an occupational therapist for someone who has trouble walking, feeding, or dressing, a physiotherapist for someone who has trouble walking, psychologist for mental functions necessary for everyday life, speech language pathologist for someone who has trouble speaking. For the cumulative effect of significant limitations, an occupational therapist could certify that if you have trouble walking, feeding, dressing, and so on. Or for life-sustaining therapy, a doctor or a nurse practitioner. So once you have sent in your form and the CRA has received your application, the information provided will be reviewed in order to determine your eligibility. They will then send you a notice of determination. If the CRA determines that you're eligible for the disability tax credit, you can claim the disability amount on your income tax and benefit return. And note that if you were eligible for the disability tax credit, as I mentioned earlier, for previous years, but didn't claim it on your tax return, you can ask for adjustments on your tax returns for up to 9 previous years. And in some cases, it can be a significant amount of money coming back. To claim the disability amount for past years, there's a box on Part A of the form when you apply, and you can make sure to select that box and sign the form, and it will automatically go back and review your taxes for all the years that you were eligible. And as we discussed earlier, eligibility for the disability tax credit is not solely based on the medical condition, but based on the effects of the impairment. So it's really important to kind of take to your doctor or your specialist a day in your life, and what a day in your life looks like, how long it takes to get up and get ready for the day, or how long it takes you to prepare food, or those that have trouble going to the washroom. It's really important to be honest and straightforward and not sugarcoated. I know it's hard to talk about, but in order to get approved for this, they really need to see what a day in your life is like. So we always tell people to be as frank as possible. If your file is not approved and you disagree with the decision, you can ask to have your file reviewed. Be sure to include any relevant medical information that you have not already sent. And if you decide to ask your file to be reviewed, just keep the following in mind. If there's any information that was needed and wasn't provided, if you had filled it out and talked more about the named condition than the effects of it, that's new information that you could send in. So make your request for review within 1 year of the date your notice of determination, the date of your notice of determination, sorry. Otherwise, you'll have to send a new form. And just to give you a sense on how long those take to be approved, it's usually 8 to 10 weeks. And even throughout the COVID pandemic, it's stayed pretty similar to that 8 to 10 weeks. But when you send that in, you don't hear a whole lot on it until it's done. So the first thing that you would hear may be that you've gotten the letter in the mail saying it was approved or denied. There's not really any kind of status indicator on it being partially completed. So the next thing I want to talk about is the child disability benefit. So the child disability benefit is a tax-free payment of up to $2,915 annually. It's made for families who care for a child under the age of 18 who's eligible for the disability tax credit. And it's paid in monthly installments to the person who receives the Canada Child benefit for the child. So it comes just along at the same time on the 20th or 21st of the month as a top up to the Canada Child benefit to the person who's receiving the child benefit for that child. If you're already getting the Canada Child benefit for the child in your care who's eligible for the disability tax credit, you don't need to apply for the disability benefit. It would be another one of those things that's calculated once your file is approved. So you'll get that automatically. If the child is not currently signed up for Canada Child benefit, it would be rare, but it does happen. You would need to make sure that the Canada Child benefit was applied for in order for this to be paid out. So next we'll have a look at the Canada Caregiver Credit, or CCC for short. The CCC is for those who support a spouse or common law partner or dependent with a physical or mental impairment. The credit may also be claimed for an individual or their spouse or common law partner's child, grandchild, parent, grandparent, brother, sister, uncle, aunt, niece, or nephew, similar to the criteria to claim the disability tax credit unused amount. So an individual is considered to depend on someone for support if they rely on them to regularly and consistently provide them with some or all of the basic necessities of life, such as food, shelter, and clothing. The person with the impairment must also be a resident in Canada at any time during the year. One note to keep in mind when claiming the Canada Caregiver Credit, the CRA may ask for a signed statement for the individual from a medical practitioner showing when the impairment began and what the duration of the impairment is expected to be. Similar to, certifying the fact that they have the disability, but that is for someone who doesn't necessarily have the disability tax credit. However, if the person is already eligible and has an approved disability tax credit on file, there is no need to provide any additional information, note from the medical practitioner or anything like that. It's understood to be applied, and they're understood to be eligible when they have the disability tax credit. So earlier we mentioned the Canada Caregiver Credit, the disability tax credit being non-refundable. The Canada Caregiver Credit is also non-refundable tax credit. So again, it means it reduces the amount of income tax that the supporter may have to pay. So the key to receiving your benefits and credits is doing your taxes and doing them on time. And this is tax season, so we're in really the full swing of our volunteer tax program. We know it's not a fun process. Very few people enjoy doing their taxes, and it can be scary for some people. But we want to stress the importance of making sure that you file your taxes. Without filing your taxes, we aren't able to calculate those benefits for you. In order to claim the disability tax credit, you must file your taxes. In order to receive the child disability benefit, we need to know what your income is for the year. So filing your taxes is the only way to get the many benefits and credits that you are entitled to based on your income. So even if you didn't earn any income during the year, we still need the information. So it's as important for someone who has earned $1,000 or $500 as it is for someone who's earned $20,000 or $30,000, because without knowing what your income is for the year, we can't send out credits and benefits to you. Now, the deadline to do your taxes is generally April 30th every year. A couple of years ago, it was extended due to COVID, but the deadline is April 30th this year. Filing by this date allows us to calculate your payments and send them to you without delays. So you should also know that you don't have to wait until filing season to submit your disability tax credit application. Submit your application at any time during the year to be able to claim the disability amount on your tax return. Again, it would have to be approved before you would claim it on your current year return. But it's a good idea to send it in, plenty of time before the tax season to make sure that it's processed. So everyone understands why we need to do our taxes. The fastest and easiest way to do your taxes is online or using a digital application. You can use tax software or even some web applications. And some of those are available at the first web address shown, canada.ca/netfile. Some of those are free and some of those are web-based only, but others I believe you can download the software and do them. The software is great because it guides you through the process of doing the taxes. It calculates everything for you. It helps make sure that you don't miss out on any benefits and credits that you might be eligible for. So it just does that automatically. It applies all of the relevant tax rules and it works to your benefit. It'll always work to the benefit of the taxpayer. And as I said, some of those tax software are even free. Some people still don't like using computers to do their taxes, and that's okay too. So you can do your taxes on paper if you prefer. You'll have to print the tax package for the province you live in. And that's at the second web address, so where it shows download a tax package at canada.ca/taxes-general-package. And if doing your taxes is a little too intimidating, you can find out if you're eligible to help at a free tax clinic. And I'll talk to you a little bit more about that on the next slide. So as I just mentioned, you may be eligible to get your taxes done by a volunteer for free, totally free. You're eligible for the service if you have a modest income, what we consider to be a modest income, and a simple tax situation. So generally, you have a modest income if you have income of less than $35,000 for an individual or $45,000 for a couple. Now, for anyone who has children, we add an additional $2,500 per child. So a couple with 2 children, if the family's income was around $50,000, we're still happy to complete your tax return for you. And those numbers are a guide, and we try to, remain as close as we can to that income threshold. But we don't turn people away if they're a little bit over that number. So we also talk about the tax situation being simple. So being simple, we do taxes for persons who have pension income, who have disability tax credit for sure, those who have unemployment or EI, people who work multiple jobs with multiple T4s. Those are all considered to be a simple tax situation. What's not simple would be if someone has a small business or income from a rental property. So in that case, those would be a little more complex than what our volunteers would be trained to do. So we would not be able to complete those based on their complexity. Tax preparation clinics are held throughout the year. You'll see many of them available for the months of March and April, every different community and location across the Atlantic region, as well as the rest of the country. Now, during the pandemic, we have created virtual tax clinics to serve those who, due to the pandemic or due to other physical barriers, may not have access to an actual in-person tax clinic location. So for more information or to find a volunteer near you, you can go to the web address or that telephone number in the Atlantic region, 1-855-516-4405. That will take you to one of the 14 coordinators in the Atlantic region, and they can point you in the direction of a free tax clinic. So that's the end of my presentation. I hope it provided you with some understanding of the benefits and credits related to the disability tax credit. And at the end of the presentation, we will be taking questions, and if you'd place them in the chat, we'll be sure to answer all of them when the presentation is over. Thank you.
Okay, so I'm here tonight, and I'm joining you from Ottawa, and I'm here from ESDC, from the Office of Disability Issues, and I'm here to talk about the Canada Disability Savings Program, or the CDSP. So basically tonight I'm going to be giving a presentation to make you aware of the Registered Disability Savings Plan and the Canada Disability Savings Grant and Bond. So if you're unfamiliar with the RDSP, it's been available since 2008 to help Canadians with severe and prolonged disabilities to save for their long-term financial security. So for the presentation tonight, I'm going to go over what the plan is, the benefits of opening an RDSP, how to open an RDSP, what the grant and the bond are, and what happens when you want to take money out of the plan. So to get started, what is an RDSP? You may have heard of an RESP or an RRSP, and the RDSP is similar in the sense that it's a registered plan and it's intended to build long-term savings, but it was created specifically for Canadians with severe and prolonged disabilities. The policy behind the plan essentially comes from the concerns that were voiced by parents of children with disabilities about how their child would be cared for when they are no longer here to care for them financially. The plan is a little different from an RRSP because the money you put in is after tax dollars. So your contributions cannot be used to reduce the amount of income you report on your taxes, but the earnings in the plan do grow tax-free and are only subject to tax when they're paid to the beneficiary. And the contributions you make are not taxed again when withdrawn. The RDSP is a legal contract. It operates for the sole benefit of the beneficiary. So all funds in the plan become the property of the beneficiary when they are deposited, and they can be used for any purpose when they're withdrawn. So having an RDSP doesn't affect federal benefit programs. So things like CPP, OAS, GIS, the GST rebate, it doesn't have an effect on any of those. Money in the plan is also excluded from income testing for determining provincial disability benefits, and this is consistent across Canada. So here in Ontario, if you have an RDSP, it means that the ODSP recipient can now have considerably more assets than the $40,000 than they are currently allowed, and it would be similar in Nova Scotia where you are. Should the person receive a windfall or come into a large amount of money that would have negatively affected their benefits in the past, they now have a savings vehicle where they can place those funds. And the Government of Canada will contribute up to $90,000, which includes up to $70,000 in matching grants and $20,000 in bonds, depending on your family income. This is in addition to the $200,000 lifetime maximum that you can have in personal contributions. So there's no annual limit to how much you can put into an RDSP, but it can't exceed $200,000 over the lifetime of the plan. So you've heard me say the beneficiary several times. The beneficiary is the individual with the severe and prolonged disability who will eventually receive the funds that are accumulated in the RDSP. So to open an RDSP for a beneficiary, the person must be approved for the disability tax credit or the DTC, which Jamie spoke all about this evening. The person must also be a resident in Canada. They must have a valid social insurance number, and they must be under the age of 60 years old. Specifically, the plan needs to be open before December 31st of the year that the person turns 59. There can only be one RDSP that's opened at any given time for the beneficiary, but you can transfer your plan between institutions if you prefer. So the holder or the holders of an RDSP is the person or the organization that opens the plan, and they're responsible for the day-to-day operation of the RDSP, including overseeing all contributions made to the plan and directing withdrawals from the plan. So beneficiaries over the age of majority, which varies by province and territory, are generally the holder of their own plan. But for beneficiaries under the age of majority, the holder must be an individual or an organization legally responsible for the beneficiary. And when the beneficiary reaches the age of majority, they can be added as a co-holder or become the holder of the RDSP as long as they're contractually competent. So when somebody meets all the eligibility criteria, they can move forward with opening a plan. And the first step in doing so is to decide what participating financial institution that you would like to deal with. So I'm going to show a slide at the end of the presentation with a list of the financial institutions that offer the RDSP along with their phone numbers. And it's important to mention that you don't need to have an existing account with any of them to open an RDSP. We highly recommend that you call the financial institution to make an appointment to open an RDSP and apply for the Canada Disability Savings Grant and the bond. So you do it all in one process. When you call and make the appointment, confirm what they require you to bring. So this is going to include the beneficiary and the holder's social insurance numbers, but it could also include other documents such as proof of DTC. So now I'm going to talk about the Canada Disability Savings Grant and the bond. So those are two mechanisms that help beneficiaries to save with their plan. So when you open an RDSP, you also apply for the grant and the bond at the same time. The grant is money that the Government of Canada will deposit into the RDSP of eligible beneficiaries to match contributions. So any contribution that's made to the plan on or before December 31st of the year that the beneficiary turns 49. So the maximum grant entitlement is $3,500 per year, and a beneficiary could receive up to a maximum of $70,000 in grant over their lifetime. Grant entitlements are determined based on income and DTC approval for the current year and the previous 10 years. So this means that you can catch up on missed grant amounts from up to 10 years previously if you were approved for the DTC in those years. So we refer to this as carry forward. Including carry forward amounts, the maximum amount of grant that can be paid into an RDSP in a given year is $10,500. So as mentioned on the previous slide, grant entitlements are based on income. So when the beneficiary's net family income is below the income threshold, so in 2022, that's $100,392, the beneficiary is entitled to $3,500 for the year, and it's done at on a matching scale. So the first $500 that's deposited into the RDSP will be matched at a 3-to-1 rate, and the next $1,000 that's deposited is matched at a 2-to-1 rate. If the family income is above the threshold, the grant entitlement for the year is $1,000. So the first $1,000 that's put into the plan will be matched at a 1-to-1 matching rate. So now we're going to talk about the Canada Disability Savings Bond. And it's an annual entitlement that the Government of Canada deposits into the RDSPs of beneficiaries with low to modest income. So I'm just going to stop and pause here because I always really like to stop and make sure that folks are paying attention to this slide because there's no contribution that's required. So basically, a person needs to have an RDSP, and if they're within the family income range, they would have the bond deposited into their account, period. They don't need to put any money into their account. It would just automatically go into their RDSP. So it's based on, again, family income. It's if the family income is equal to or below $32,797, and that's for 2022, the beneficiary is entitled to $1,000 in bond for the year. If the beneficiary's family income is above $32,797, but below $50,197, they're still going to get a portion of that $1,000. But if their family income is more than $50,197, then they're not entitled to the bond that year. And it's important to mention that it's the family income and of the individual. So when the child, if the RDSP belongs to a child, they're the beneficiary, as soon as they reach the age of majority, the family income is no longer based on the parent's family income. It is based on the individual's family income. So at that point, a person may not have qualified to receive the bond amount, but based on their own individual income, once they become the age of majority, they may start being able to collect the Canada Savings Bond. So when an RDSP is first opened and the bond is applied for, a beneficiary will receive all the entitlements for the current year and for 10 previous years, so up to a maximum of $11,000. Every subsequent year, they're automatically going to receive their annual entitlement until they reach their lifetime limit of $20,000. Now, the RDSP is intended as a long-term savings plan. So to encourage long-term savings, all the grant and the bond that's deposited from the government, it needs to stay in the plan for at least 10 years. Any grant and bond deposited into an RDSP within the previous 10 years is subject to repayment to the Government of Canada if you make a withdrawal. So this is called the Assistant Holdback Amount, or the AHA. If a withdrawal is made within 10 years of grant or bond being paid into the RDSP, then grant and bond must be repaid to the government at a rate of 3-to-1 up to the total amount of the AHA. So for example, if someone had received grant and bond every year for the last 5 years, and now they want to withdraw $500, $1,500 worth of grant and bond would be repaid to the government. It's important to note, though, that you never have to repay private contributions that you make to the plan to the government. In the case where the RDSP is closed or the beneficiary dies, the total amount of the AHA must be repaid to the government, and the remaining funds in the plan either go to the beneficiary or to their estate, depending on the situation. Withdrawals from an RDSP are called payments. So ad hoc withdrawals, one-time only withdrawals, they're called the Disability Assistant Payments, or DAPs, and they can be made at any time. But keep in mind that the repayment obligation is still going to apply if grant or bond has been paid within the last 10 years. DAPs are limited by a formula that are found in the Income Tax Act, and in most cases, they cannot exceed 10% of the assets or the holdings within the assistant holdback, or within the plan. And that's not including the assistant holdback amount. Regular withdrawals from the RDSP must commence by the end of the year that the beneficiary turns 60, but these can begin earlier without having to repay anything if it's been at least 10 years since the last time grant or bond was deposited. These are called Lifetime Disability Assistant Payments, or LDAPs, and they're also prescribed by the Income Tax Act. Once they're started, these payments must continue at least annually until all the funds are dispersed out of the RDSP or the beneficiary dies. Both DAPs and LDAPs are made up of proportional amounts of the funds that are held in the RDSP, except, of course, the AHA, which is the grant and the bond deposited within the last 10 years. So when you take money out, you're getting a portion of your contributions that you've made to your RDSP. You're getting a portion of the earnings because you've invested, if you choose, your RDSP amounts, and a portion of the vested grant and the bond. So as mentioned earlier, you're not taxed on the private contribution portions of the withdrawal. However, the grant and the bond and the earnings portion is taxed. The non-taxable portion is determined by a formula in the Income Tax Act. So this is the slide I was mentioning earlier on. This is the current list of the RDSP issuers or financial institutions that offer the RDSP along with their 1-800 numbers. So we recommend that when you do go to your appointment at the branch, that you should bring the 1-800 number with you for that specific financial institution, because the institutions administer the RDSP centrally. So when you visit your branch, the staff might not be very experienced with the RDSP, especially if they've never opened one before. So if you bring the 1-800 number with you, you can direct the representative to call their own expert, if you will, and they will be able to help them with any questions they may have on the back end for administration. And that really is the end of my presentation. So like Jamie, I'm happy to answer any questions you may have. I'm also going to just point out here that we do have additional information online that you can go and have a look at. We have our RDSP brochure that you can find in English and French online. We also recommend, if you have other questions and you'd like to talk to a person on the phone, you can call 1-800-OH-CANADA and they will direct you in the right direction, or you can email the RDSP inbox. And there's also some really helpful info capsules that are online that explain the RDSP, the grant, and the bond really specifically if you're looking for some really detailed information.